Hey there, savvy investors. Welcome back to my channel. Today we're going to explore a topic that's near and dear to many of our hearts, which is living off dividends. Imagine having a passive income of, let's say your objective is $30,000, allowing you to enjoy life on your terms. In this video, we're going to dive into three powerful strategies to fast track your journey to financial freedom through dividends. So these strategies, as I mentioned, there are three ways that you can achieve financial freedom through the financial market. The first one is to invest in dividend aristocrats. The second is investing in real estate investment trusts, which we call commonly REITs, and investing in covered call ETF. So in this video, we'll explore all these three options, discuss the advantages, and also the risks involved. So we'll break down each option and discuss the potential risk, provide examples to help you determine how much money you would need to reach that 30,000 annual income goal. I will also share an Excel file that you could use also to set your own amount and have your own scenario. So option one, investing in dividend. So the first option is to investing in dividend aristocrats. A dividend aristocrat is a term used to describe a select group of publicly traded companies known for their consistent and long-standing track record of increasing their dividend payments to shareholders year after year. So these companies are often seen as stable, reliable investments, and particularly for income seeking investors. So, here are some key details about dividend aristocrats. To qualify as a dividend aristocrat, a company typically needs to have increased its dividend payout every year for a minimum period of 25 years. So imagine this is a business, this is a stock that's been paying dividends for 25 years and not just paying those dividends, increasing them every year. This is, of course, a remarkable record of consistency, reflects strong financial stability and commitment to returning value to shareholders. So these are really like big household names, usually 3M, Johnson and Johnson, Coca-Cola. So these are the companies that are usually part of the dividend aristocrats. I will post the link for the full list of dividend aristocrats. The second characteristic of dividend aristocrats is their presence in various sectors. So you could be found in various sectors and industries, including consumer goods, healthcare, technology, finance, and more. They represent diverse cross-section of the economy, showcasing the ability to thrive in every market condition. Uh, so make sure when you invest in dividend aristocrats to have a portfolio that's diversified across various industries. The dividend yield. While dividend aristocrats are known for their consistent dividend increases and their dividend yield, the the average, however, the average dividend yield is usually between 2 to 4%, because these companies still need to grow. So they're not just paying all their net income in dividends. So they invest in their future and in their growth. And this is something to keep in mind here. When you're investing in dividend aristocrats, you're not just seeking dividend. You're also gonna get price appreciation with time. A company that has a company's financial health and profitability improve, it can attract more investors, leading to an increased demand for its stock. This increased demand can drive up the stock price, resulting in capital appreciation for shareholders. So when you're owning these, you're not just there for the dividend, you can also get price appreciation, which is called capital appreciation. And this brings me back to total return. Your total return is the sum of the dividend income received and any capital gain or losses from the changes in the stock price. So dividend aristocrats often offer a competitive total return over the long term, making them appealing to investors who seek both income and potential for stock price growth. I personally prefer this option to get price appreciation and not just the dividend. I'm interested in both because it produces what we call compounding effect. The combination of dividend reinvestments and price appreciation can lead to a compounding effect over time. As you reinvest dividends to purchase more shares, your ownership of the company grows and potentially accelerating your capital gains and increasing the amount of dividend received. Dividend aristocrats also come with another bonus that they are really resilient, especially when the market is not doing well. investors tend to go to safe havens, and dividend aristocrats are considered safe havens because, as I mentioned, companies that have a long track record of paying dividend, usually they are strong financially. So they are considered as a safe haven, and they tend to have price appreciation during market when the market is not doing well. So the average yield for dividend aristocrats hovers around 4%. Now let's crush some numbers to determine how much you need to reach that $30,000 annual income goal. Money needed, so you have to get $30,000, you have to reach an amount of $750,000 of savings to reach that $30,000 goal. This is assuming a dividend of 4%. Now, what are the potential risks for investing in dividend aristocrats? There is obviously the market risk. Even the most established companies can face market downturns. Economic conditions can impact a company's ability to maintain or increase that dividend payout. So, diversification is a way to protect yourself against market risk. Interest rate risk. Dividend yields can be affected by changes in interest rate because when interest rates rise, dividend usually become less attractive for some really hardcore conservative investors. They go back to regular saving account. Company specific risk. I mean, while dividend aristocrats have a history of consistent dividend, individual company can face a challenge. So this is why, again, you need to diversify. So that's for the first option to achieving passive income. The second option is investing in real estate investment trusts, REITs. REITs are companies that own, operate, or finance income producing real estate properties. These properties can include various types, so residential, commercial, shopping centers, industrial warehouse, hotels, healthcare, data centers. So, one of the primary requirements is that they must distribute at least 90% of their taxable income to shareholders in the form of dividends. So this means that REITs usually have a high dividend yield, and on average it's above 7%. So it's 7%. It could be even higher, but when you see like a dividend yield for a REITs that reaching 15, 20%, you really have to crunch in the numbers, looking at the financial ratios to to assess whether that dividend is stable. For myself, I sustain myself to REITs that pay around between 6 to 10%, and I do my own numbers also, crunch the numbers to look at the financial ratios to assess whether that dividend will be stable and will be reliable in the future. So REITs often diversify their portfolio. This is something that you need to look at when you invest in a REITs. Try to dig into go to their website and check whether they just have one type of properties or they have various type of properties. So let's say if they invest in residential and commercial, you are safer than in a REITs that invest only in residential. So do you understand? So this is the trick with REITs. You have to invest in REITs that are diversified across various assets. That for sure helps them maintain the dividends, be strong financially. And REITs in general are popular choice for income seeking investors due to the high average yield, which is around 7%. Price appreciation. Does REITs appreciate with time? Their price appreciates with time so you can get some capital? Yes, it can appreciate, and this is for various reasons. It could appreciate because their property, the properties that they manage have gone up in value. They made some renovation, they got more quality tenants. All these things have an impact on the price of the REITs. And also it depends also on interest rate. When interest rates goes down, people tend to invest in REITs more. So that's why like there is a capital growth possible with REITs also. So let's calculate how much you would need to reach $30,000 annual income goal with REITs. So for $30,000, you would need $428,500 at an average yield of 7%. So we see here it's really much lower than what you would need with dividend aristocrats. What are the potential risks with the REITs? There is interest rate. That's the number one risk for REITs. REITs can be highly sensitive to interest rate changes. If interest rates rise significantly, the value of REIT shares may decline, affecting your income. Economic downturns. In challenging economic times, such as a recession, Some REIT sector like commercial real estate may struggle. Diversify across different type of REITs to reduce sector specific risk, as I discussed earlier. Regulatory changes in tax laws and or regulation can impact REIT income. So staying informed about potential policy change is essential here. So for option three, which is I would say a much newer option, started like a couple of years ago, which is covered call ETF, investing in covered call ETF. Covered call ETFs can provide a really high average yield, typically around 11%. It could be even higher, but again, pay attention to the ones that offer 20, or because usually there is capital erosion with those ones. Stick with the ones that offer a regular type of yield for this type of covered call ETFs. Usually it's between 10 to 12, 13%, not more than that. So it's perfect as an income strategy. Covered call ETF generate income by selling options on their portfolios underlying assets. They receive premiums from the sale of these options, which are then distributed to investors as dividends. In other words, basically, so you have a portfolio of stocks. So instead of just holding the stocks and getting that dividend, what the manager of a covered call ETF would do is they will hold those stocks but sell options on them. The option does two things: downside protection, because he would set a price for that stock for the following month. So he would tell investors, hey, I'm willing to sell this stock in a month for that specific price. So he locks a certain amount of profit, but and that the investor that buys that option has to pay a premium to that manager. So the manager goes back and pays you the dividend plus the premium. So you're getting a distribution that is much higher than what you would get with just dividends. So covered call ETF, you have a downside protection, so they are good in terms of reducing volatility compared to owning just the stock. So the downside protection is why they use the term covered, means that the ETF owns the underlying assets it's selling call option on. This provides some downside protection as the ETF has the assets to cover the option if they are exercised. But the only drawback of covered call ETFs, one of the main drawbacks, is the limited upside potential. Because as I mentioned, he's telling the market in a 1 month, I will be selling this at this price. Is there anyone interested by this option? So by doing that, you kind of you are limiting and capping your growth. So with price appreciation would be kind of limited with covered call ETFs. It's still there depending on how much, because not they don't usually apply the covered call strategy on the whole portfolio. Usually they would apply it on 50%, 30%. So if you're interested in a covered call ETF, I encourage you to go to the website of the issuer to discover the covered call strategy is used on how much of the portfolio. So if it's used on 50%, so you're still having 50% possible capital appreciation on the 50% of the portfolio that's not using covered call, and the other 50% that's using covered call, you're mainly getting distributions and not a lot of capital appreciation. So that's something to keep in mind. With this strategy, because it's 11% average dividend yield, you only need $272,727 to reach that passive income of 30,000. So it's really doable with covered call ETFs. Uh, they are, let's say, the quickest way to get to the passive income goal. But again, understand that with this type of covered call ETF, there are two risks that I can see. The first risk is that you're not getting capital appreciation. Avoid covered call ETFs that pay like insane yields, because you will have capital erosion. So you will get the dividends, but the ETF that you own, its price keeps dropping. So your total return at the end of the day is maybe nil, because what you're gaining in dividend, you're losing in capital. So you have to restrain yourself to covered call ETF that offer a reasonable yield for this type of investment, and just read the strategy. And if you're fine with it, then you could invest in covered call ETF. Uh, and so you have the option to reinvest those dividends. This obviously will compound the effect of, and you reach quickly the 272,000. or you could place the dividends in other investments. So in overall, you will need a portfolio valued at 272,000 in covered call ETFs to generate an income of $30,000. It's the lower capital requirements compared to other previous options. Potential risk with covered call ETF, I touched on that a little bit. So you have market volatility. Covered call ETF often utilize options to generate income, which mitigate volatility to some extent. However, during periods of extreme market volatility, these strategies may not perform as expected. It comes back to the manager's experience and ability to read the market. Cap on upside potential, I discussed that. So by selling call options on underlying stocks, you may limit your potential capital gains during strong bull markets. Active management, usually covered call ETF require active management and may incur higher management fees compared to traditional ETFs. So make sure to read the management expense ratio and pick one that has a low MER. So conclusion, so in this video we've explored 3 strategies to fast track your journey to financial freedom through dividends, investing in dividend aristocrats. Uh, so with an average yield of 4%, it requires you a portfolio value that's $750,000 to generate $30,000 annually. Investing in REITs with an average yield of 7% requiring a portfolio of approximately 428,000, and investing in covered call ETFs with an average yield of 11%, requiring a portfolio of around $272,000 to generate $30,000 annually. Each strategy has its potential risks, and it's crucial to consider your risk tolerance and investment horizon. Diversifying your portfolio across these strategies or other income generating assets can further enhance your financial security. So thanks very much for watching the video. If you like the content, please don't forget to hit the like button and subscribe. Thank you.